So everyone, welcome back to Corporate Decoder, the place where we dig into the nitty-gritty of corporate filings. Today we're cracking open FS Credit Real Estate Income Trust's annual report, or Form 10K. Get ready for a deep dive because this report's got more twists than a pretzel factory. So what's the headline? This report covers the full year ending December 31, 2024. Think of it as a yearly checkup, giving investors a clear picture of how the company performed, the risks it faces, and where it's headed. FS Credit Real Estate Income Trust is a player in real estate debt, focusing on senior loans secured by commercial properties. They aim to give investors steady income and protect their capital. First things first, it is not a shell company. Now, before diving into the numbers, let's set expectations. This report might seem like a snooze fest of financial jargon and legal disclaimers, and while we'll decode it, keep in mind that there are a lot of forward-looking statements which are essentially educated guesses about the future. The company even acknowledges that actual results could be way off, so take everything with a grain of salt. FS Credit Real Estate Income Trust is in the business of real estate debt investments. They're managed by FS Real Estate Advisor, which in turn has Rialto Capital Management as its sub-advisor. Their main game is originating and acquiring senior loans backed by commercial real estate. Specifically, they love senior floating rate mortgage loans, especially those for commercial properties undergoing renovation or repositioning. These are called transitional loans. Think of it like this. Instead of financing a stable, fully occupied building, they're funding the Gelliap phase. Now let's get to the juicy stuff, the financials. They use a mix of financing arrangements, including collateralized loan obligations, CCLOs, repurchase agreements, and revolving credit facilities. As of December 31, 2024, they have $5.7 billion outstanding across all these arrangements, with another $2.3 billion available. Those $7 billion outstanding across all these arrangements, with another $2.3 billion available. Those CCLOs are a significant piece of the puzzle at $3.7 billion outstanding. And how much do they pay on all that debt? It varies, but their weighted average interest rate is in the tech year 2% range. It includes term SOFR and SOFR average. Now, what are the risks? Well, many of their loans are tied to floating interest rates expressed over SOFR. If those benchmark rates rise, it'll cost them more to borrow, potentially squeezing their profits. Also, and this is an important piece, they are externally managed. They depend on their advisor and sub-advisor who might have conflicting interests. Speaking of risks, this report dedicates a lot of real estate to outlining potential downsides. A big one, there's no public market for their stock. So if you want to cash out, you're pretty much stuck selling back to them, and that repurchase is not guaranteed. And like any investment, distributions aren't guaranteed. They can pay distributions from sources other than cash flow, which sounds great, but it means they're digging into their capital rather than generating money. They then dive into a whole slew of conflicts of interest. The advisor's fees are tied to their NIV, which they calculate, giving them incentive to inflate the value. The people managing the company have other gigs, potentially dividing their attention, which could lead to the company not generating the desired yields, which may further limit their ability to generate desired returns. In short, it is conflicts of interest everywhere. Competition. They are not the only company to lend to commercial properties. If there are better options, the yields may lead to decrease, limiting the ability to generate desired returns. Of course, uncertainty about US trade policy and a global instability also play a role. These things might have an adverse effect on their business, financial condition, and results of operations. They also might invest in subordinated loans, which naturally are riskier than senior loans because they're further down the repayment chain. There are a whole slew of issues related to those factors and how those situations can go south for a loan provider. There is no report or attestation to management's assessment of internal control. Their headquarters are in Philadelphia. So how did they actually do? Well, they break it down in management's discussion and analysis. Remember those risks I mentioned? Here they go over the numbers and give their take on the market conditions. The report notes they're navigating economic uncertainty. That includes rising interest rates, which are making debt financing more expensive, potentially limiting their ability to originate new loans and grow, negatively impacting their operating results. Here's their loans receivable portfolio, the main driver for this company. For the year ending December 31, 2024, it consists of 145 loans with a principal balance of $7.5 billion. The average cash coupon and weighted all-in yield are at FICO 50% and Tobasu 3PL 5-tier A2H4E, I think 34%. SOFR was lower than it was the previous year, which had a value of 385,534%. The company's cash decreased significantly, almost 2x year over year. A bit worrying for long-term prospects in that the cash flow is getting weaker. Now, the moment of truth, are they making money? Let's find out by diving into the financial statements. Net income attributable to FS Credit Real Estate Income Trust, Inc. took a dip, going from $150 million in 2023 to $170.24. That increase of income couldn't overcome the debt that the company has to pay. Also, as a reminder that there is no established market exists for the registrant's shares of common stock. If you enjoyed bedtime stories, you can check out all the exhibits Credit Real Estate Income Trust is playing in a high-stakes game. The company is facing high interest rates as well as other economical risks. So their key strategy seems to be to continue expanding their loan portfolio, but that depends heavily on favorable market conditions, their ability to make wise investments, and their advisory team. One of the concerning factors is that the company has a lack of internal control attestations. That is a key warning sign because the higher that control, the less likely they are to cook the books. Is FS Credit Real Estate Income Trust going to be a success story or a cautionary tale? Only time will tell. Thanks for watching. If you found this decoder ring helpful, please hit the like button, subscribe and comment.